Financial statement modeling is a structured analytical process used to forecast a company's future financial performance, financial position, and cash flows based on historical data, assumptions, and strategic expectations. The program explains that financial models integrate the income statement, balance sheet, and statement of cash flows into a connected forecasting framework. Analysts use these models to estimate future profitability, evaluate investment opportunities, assess credit risk, and support valuation analysis. Financial modeling is widely used in equity research, investment banking, corporate finance, and portfolio management because it allows analysts to evaluate the financial consequences of business decisions under different economic scenarios and strategic assumptions. The foundation of financial statement modeling begins with analyzing historical financial statements and identifying key business drivers. Analysts review trends in revenue growth, profit margins, asset turnover, working capital management, capital expenditures, and financing activities to understand the company's operating structure and historical performance patterns. The program emphasizes that reliable forecasting depends on understanding the economic relationships underlying financial statements rather than simply extrapolating historical numbers. Analysts must identify the major factors influencing revenue generation, cost behavior, and profitability. Industry conditions, competitive position, economic trends, and management strategy also play critical roles in determining future performance assumptions within the financial modeling process. Revenue forecasting is often the starting point of financial statement modeling because revenue growth drives many other financial variables. Analysts estimate future sales using assumptions regarding market growth, pricing trends, customer demand, market share, and macroeconomic conditions. Different industries require different forecasting approaches depending on business models and operational characteristics. After projecting revenue, analysts forecast expenses such as cost of goods sold, operating expenses, depreciation, interest expense, and taxes. Expense projections may be modeled as percentages of sales, fixed costs, or relationships tied to operational drivers. Accurate forecasting requires balancing historical trends with forward-looking expectations regarding economic conditions and strategic business developments. Balance sheet forecasting is another essential component of financial modeling. Analysts project current assets, long-term assets, liabilities, and shareholders' equity based on expected operational activity and financing decisions. Working capital accounts such as receivables, inventory, and payables are often forecast using turnover ratios or days-based assumptions. Property, plant, and equipment projections depend on expected capital expenditures and depreciation policies. Financing assumptions determine debt balances, interest costs, and equity changes over time. The program notes that financial models must maintain consistency among statements because changes in one account affect multiple areas of the financial statements. Maintaining proper balance sheet relationships is therefore essential for producing realistic and internally consistent forecasts. The statement of cash flows links the income statement and balance sheet forecasts by explaining how projected operations, investments, and financing activities affect cash balances over time. Analysts forecast operating cash flow based on projected earnings and working capital changes, while investing cash flows reflect capital expenditures and acquisition assumptions. Financing cash flows incorporate debt issuance, repayments, dividends, and share repurchases. Cash flow modeling is particularly important because companies may report accounting profits while experiencing weak liquidity or financing pressure. The program emphasizes that cash flow analysis improves assessment of earnings quality, financial flexibility, and solvency. Strong financial models therefore focus not only on profitability but also on the company's ability to generate sustainable cash flow. Sensitivity analysis and scenario analysis are important techniques used in financial modeling to evaluate uncertainty and risk. Sensitivity analysis examines how changes in individual assumptions affect projected financial results, while scenario analysis evaluates the combined impact of multiple changing assumptions under alternative economic conditions. Analysts may model optimistic, base case, and pessimistic scenarios to assess the range of potential outcomes. These techniques help identify key drivers of valuation, profitability, and liquidity risk. The program emphasizes that forecasting involves uncertainty because future economic conditions, competition, interest rates, and consumer demand may differ significantly from expectations. Incorporating sensitivity analysis improves risk assessment and supports more informed investment and financing decisions. Financial statement models are widely used in valuation analysis, particularly in discounted cash flow, DCF, valuation, and comparable company analysis. Forecasted earnings, cash flows, and balance sheet data form the basis for estimating intrinsic value and assessing investment attractiveness. Analysts use financial models to evaluate merger opportunities, creditworthiness, capital budgeting projects, and strategic alternatives. Reliable models improve decision-making by quantifying the financial effects of operational changes, financing choices, and economic scenarios. However, model quality depends heavily on the reasonableness of assumptions and the analyst's understanding of business fundamentals. Poor assumptions or unrealistic growth expectations can lead to inaccurate forecasts and misleading valuation conclusions. Although financial statement modeling is a powerful analytical tool, it also has limitations that analysts must recognize. Models are simplified representations of reality and cannot fully capture unpredictable events such as economic crises, technological disruption, regulatory changes, or sudden shifts in consumer behavior. Forecast accuracy declines over longer time horizons, and even small assumption changes may significantly affect valuation outcomes. The program emphasizes that financial models should support, not replace, professional judgment and qualitative analysis. Effective modeling requires continuous evaluation of assumptions, industry developments, and company strategy. A strong understanding of financial statement modeling enables analysts to forecast performance more effectively, evaluate risk systematically, and make more informed investment, valuation, and strategic financial decisions.